Right. Hey guys, we're just waiting right now for the session to kick off here for the Fireside chat. I've been having computer issues again, so I'm trying to fix a couple of things. I'm going to try and pull up earnings. So I'm going to sit here quietly for a minute while I get this going. This, Wild Frenchie, this is the day for the event. Oh, let me see here. Looks like they're going to start shortly. Let me see if I can get the earnings. Not earnings, but the ticker symbol up. So we can see how this does while they're talking. All right. Hey, Nanu. 1 second here. Just pulling some stuff up. Let's see. Earnings. All right. There we go. Cool. All right. So we're just waiting for them right now. It says to stand by. They're going to start shortly. We've got some charts and things that we can look at for the company too. We're going to listen to what they have to say and then go from there. So I won't talk too much beforehand. We can chat though. And it looks like, do I have this up? Yeah, okay, cool. It looks like miners were taking a little bit of a break here. Yeah, still having computer problems. I got it up at the last minute. Thank God. Let me make sure audio. I'm gonna play something on YouTube just to make sure.
After being employed as Stellantis.
Yep. Okay. Good. We got that. I'm just waiting on them. Hey, Ahad. Hey, everybody. We're just waiting a second on these guys. I'm trying to play around with a few things real quick here. So if I'm distracted, that's why. Oh, looks like we're going. Maybe. Let me hit the play button.
Good afternoon, everyone, and welcome
mute,
to our
guys.
virtual fireside chat with CleanSpark. I'm Mike Colonnese, Managing Director and Senior Crypto Analyst here at HC Wainwright. We are very excited to have Matt Schultz, CleanSpark's Executive Chairman, and Zach Bradford, Chief Executive Officer, for today's event. Guys, great to have you. Really appreciate you taking the time.
Thanks for putting it together, and thanks for hosting, Mike. We're excited, and just a personal note of gratitude. The fact that you opened it up to all of our retail investors and anybody that might be interested is a big deal. So thanks for that.
Yeah, appreciate it. Thanks, Mike.
Absolutely. We appreciate fellow Bitcoiners here at the bank, and it's great to have you on the call today. So for those of you who aren't too familiar with the CleanSpark story, Matt and Zach are really the brains behind CleanSpark, a company that has grown to be one of the largest publicly traded Bitcoin miners in the world. Looking at it today, the company has a market cap of about $4.5 billion and 16 exahash of total operating capacity online and hashing today. But what I really want to zone in on too is beyond the numbers. I've been very impressed by the company's corporate culture, as CleanSpark has some of the most engaged employees I've personally met with in the industry, having toured many mining facilities throughout my career, from senior management all the way to the boots on the grounds at the company's Bitcoin mining facilities throughout Georgia. And I think this is an important aspect to the story that I believe is really underappreciated. So I just wanted to touch on that. Now, before diving in, we also want to remind investors on the call today that CleanSpark is our top stock pick for 2024 and is the only publicly traded miner to have outperformed Bitcoin year to date and by a wide margin. And looking ahead, we believe the company is well positioned to not only continue outperforming its peers, but also Bitcoin as we look out through the balance of 2024. As for today's agenda, we'll cover a number of important topics to better familiarize investors with CleanSpark's Bitcoin mining operations, growth initiatives, and explore how the company has been able to outgrow its peers in recent years. So today's event should run for about 1 hour, and if time permits at the end of today's session, we will pull questions from the audience. And I'll also add, if you're interested in scheduling a follow-up one-on-one meeting with the management team after today's event, I'm more than happy to set that up. You can go ahead and send me an email directly, and we can coordinate that. With that being said, let's jump right in. We have a full agenda today. Matt, Zach, again, appreciate the time. And I think it would be great to start, for those on the call who are relatively new to the story, to really kick off the discussion with an intro to CleanSpark, how you got into Bitcoin mining, and an overview of your operations today.
Great. Yeah. So it's kind of an exciting journey. I was speaking with somebody that said, you guys have pivoted from one thing to another, and now look where you're at. And I have a different perspective. I think if you stand where we are today and you turn around and look back, it's a straight line. So Zach and I met on a renewable energy company, whereby we had some intellectual property that enabled us to convert waste products into clean gas. And we evolved that company and merged with the microgrid company. So in our history, we understand energy generation, but through the microgrid company, we also developed a portfolio of IP that enabled us to have kind of insight on interoperability with the utilities and demand response programs and peak shaving and load balancing and different aspects and components of an energy system. What we learned is that Bitcoin is really all about energy and effective usage of energy and optimizing a team using all of the kind of advantages that came out of several years of renewable energy generation and development, modeling solutions around cost avoidance or time of use charges, or even greenhouse gas emission exposure. And so when you feather all that in and you layer it in, that really provides us some insight that I think maybe is unique in the Bitcoin mining space. Zach had an opportunity to fly out to potentially propose a microgrid solution for a Bitcoin mining company back during COVID. And he called me from the Atlanta airport. I could hear through his mask saying, "Hey, hear me out. This is going to sound crazy, but what if instead of selling these guys a microgrid solution, what if we buy a data center and we mine Bitcoin? Because I think understanding energy with the detail and granularity that we do, we could really do it different and better than everybody else." And that was kind of where it started. Our board had just a little bit of I think lack of familiarity with what it meant to mine Bitcoin. And so it took an educational process. Zach did a great job. We brought in a consultant that we bought the company from initially that had mined more than 50,000 Bitcoin personally. He kind of helped with our education into the space and that segue. And from that point forward, it's just kind of been, off to the races. And, props to Zach and the team. They've done an impressive job with execution.
Yeah, it's truly been a great story, and sure you're bearing the fruits of that pivot now. So it's really great to see the progress over the years, guys. And if we fast forward, right, CleanSpark is the second largest Bitcoin miner by market cap in the industry, second only to Marathon. Really a testament to execution, right? When we talk about growing faster than the majority of your peers over the past couple of years, what do you guys attribute the company's success to, and really what differentiates you from other miners out there? There's a lot of public companies in the space that investors can choose from, but what differentiates CleanSpark?
So I'm going to address something from where I sit that I think affects how I view the world, which is how we built the company around it. And that is strategy over ideology. We're in an industry that carries heavy ideology about what you should do with Bitcoin, how you should use Bitcoin, what it means. And at the end of the day, I personally buy into what Bitcoin means for the world. I think it can make it a better place. But we're here to run a company and be strategic. So everything is done from a strategy over ideology approach. And that can mean not always pursuing the ideology. An example of this is we sold Bitcoin at the peak of the market last year because everybody else thought you should hold it. And I looked at the market and said, everyone's lost their minds. We've hit a point where euphoria has taken over. And we sold it. And we continued to sell Bitcoin until last June. We really started rebuilding the balance, because same thing, we looked at the today, not the yesterday, and not what we want tomorrow to be, but had vision based on the facts that were in front of us and decided it was time to build our HODL. In the years between those 2 points, right, was a bear market. And we grew in the bear market. So when everyone else was, worried about, today, we were growing for tomorrow, because we'd positioned ourselves with no debt. We positioned ourselves where we had sold our Bitcoin at the peak of the market, used our balance sheet the way we should in a healthy way, and we grew. We grew by acquiring a lot of distressed assets. So again, those are 2 points in time that were key inflection points for us. And right now we're continuing to build into this market. And although the assets may or may not be distressed as we go into halving, the opportunities are immense. And they're immense because of where we position the company. And I hate to use this word, but the word is relevance. And, we knew, or believed, I should say, 3 years ago, that we needed to be amongst the top 4 companies by market cap and by production. And everybody else would be irrelevant. And so if we were not one of those companies, we would lose on the opportunities for the next cycle. Because again, at the beginning of this cycle, we were thinking about what's going to happen in 30 days. And now, as we were well prepared for it, we're going to start to think about 2028. And I think the forward-looking mindset, always pursuing strategy above all else, has allowed us to be successful when, the opportunities to me were obvious, but they clearly weren't for the rest of the market. And so timing is something that we pride ourselves in, and we're going to continue to do, because we also have a belief that success is rented and that rent's due every day. And that is a mindset of our management team. We need to be better tomorrow than we are today. We're not going to ride on our laurels. We're not going to say, hey, we made it and high five. We're going to continue to build this company long into the future to be the very best Bitcoin mining company.
A question on a lot of investors' minds as of late is why the public miners have underperformed Bitcoin to start the year, with the exception of CleanSpark. In your view, what forces are driving this underperformance, and why do you believe an investor should consider making an allocation to one of the large public miners as opposed to maybe purchasing into one of the spot ETFs or the digital asset itself?
Oh, great questions. So I think a couple of things. Obviously, share price has a lot to do with supply and demand. And we've been very judicious about our use of equity. We told our shareholders 2 years ago that we would use equity if and when it was accretive within a couple of fiscal quarters. And we've really stuck to our guns on that. I mean, Mike, through the bank that is your employer, we've gone through a couple of $500 million ATM transactions. And during that same period of time, our shares are up 672% in 12 months. That's because of that disciplined approach. We haven't done an overnight offering. We didn't do a convertible debenture. We were very opportunistic when the market was strong. We raised capital when it made sense, and then we immediately deployed that capital. Just a quick gee whiz file, right? We plan all this stuff way ahead. We started planning for this having 4 years ago, and the fleet of equipment and the expansion that we're pursuing now is in preparation for 2028. So it's really been strategic to not to echo Zach's points too strongly, but there are opportunities that there's deviations from the norm. We had an executive meeting this morning, and some of the stuff that's going on in Dalton is running a bit ahead of schedule, right? So I don't know if you know this or not, but if you are an ASIC miner and you wanted to fly to the United States, that ticket costs you $110 for that seat for one miner if you plan it a certain period of time in advance. Now, if you travel on short notice, that ticket's going to cost you double. So our team, just to give you an example, they find out that we have 4,956 slots coming available sooner than we predicted. And so proposed spending double the price of a plane ticket for those 4,000 miners to get it here on time so we can put those things in place hashing before halving. So that's kind of the way we think about operations. And that's a very specific example, but I just wanted to highlight the fact that it's all about efficiency. Now, relative to our peers, I think we've been more selective in the use of equity, but also more efficient in the deployment of equity, in the choices of the equipment that we've used, in the way that we build out our facilities. But more than anything else, it's about our people. I mean, we all have ASICs, we all have power supply units, we all have transformers, we all have switch gears. Everybody has basically the same thing. We chose a different path to start with, and that is vertically integrated, self miners, and literally with very few exceptions, every person that touches a miner at CleanSpark is a shareholder of CleanSpark. So our interests are aligned. We've brought maintenance and repairs in-house. They have microscopes with massive screens to do warranty work on our own fleet, all the way down to the chip level on site. So we have this, we have a small fleet of surplus rigs, but when one goes down, we pull it off, put another one on, plug it in, the other one goes in the queue and it gets fixed. So we don't have these real big lagging periods of time. We're also not reliant on a third-party host. We control our own destiny. So why invest in CleanSpark or a miner rather than an ETF? It's a great question. The ETFs have given credibility as an asset class to Bitcoin. The difference is owning an ETF, you don't own the Bitcoin. You don't have the keys. You own exposure to Bitcoin. The ETFs sell exposure to Bitcoin, and by definition, as you know, they're called spot ETFs. So they acquire that Bitcoin at the then spot price in the market. As a Bitcoin miner, you've seen our gross and net margins. We acquire Bitcoin at about a third of that spot price. So as a vertically integrated miner that holds Bitcoin, you're now investing in exposure to that same Bitcoin at about 66% less than what you're going to get from an ETF. And then the last point on that, in December, about 12% of the Bitcoin awards we received over a period of time were generated as a result of transaction fees on the Bitcoin blockchain. You don't have that benefit in an ETF or even on a MicroStrategy. We have the benefit of having opportunities to participate within that Bitcoin mining ecosystem to reap the rewards when the demand for block space is high. We get that benefit, and that directly impacts our shareholders. So I know it's a really long answer to your question, but I think, to use Zach's point, relevance, these are all points of differentiation. And I think that's ultimately what's proven to be relevant to our investors, both retail, but especially institutional. And we're seeing a rapid growth in the number of institutions that have chosen to hold our security.
Mike, I'm going to piggyback on what Matt said, and I'm going to give him maybe a slightly condensed answer to this. Use of capital. Use of capital means you're buying machines and facilities. I believe we're amongst the top where we have the lowest costs to ultimately produce an exahash of all the miners. So that's first point. Second point, if you look at all those servers, it doesn't matter if they're not producing Bitcoin, how many you have. As far as production goes, you can see the production on the public blockchain. It's out there for everybody. One of our peers who is showing over 10 exahash, so about 60,000 more servers than we have, we're actually producing plus or minus 5% of what they're doing. So that means that there was capital deployed to buy 60,000 more servers than we have, and we're producing nearly as much as them, and we may even catch them this month. So again, I don't need to name names or anything on that, but my point is, it's about how you deploy the capital at low cost, how you produce with that capital, and then the last point I'm going to say is buying miners because of the ETFs. Because ETFs buy at spot, and currently they seem to have an insatiable appetite to scoop up more Bitcoin. That means that our margins are just going to get better. So the biggest, most efficient miners are going to reap an even bigger reward because of the ETFs. So you're actually pushing a greater, alpha towards a miner on a long-term basis.
Really great insights, guys. Appreciate that. And I'm sure it's very helpful to the investment community, both on the institutional and retail side on the call today. Switching gears over to taking a deeper look at your mining operations. Now, you own and operate 5 data centers in the state of Georgia, where most of your deployed capacity is currently located. What makes Georgia a good state to set up shop, and what strategic advantages or disadvantages are there to you having most of your capacity deployed in the one state?
You know, when we got started, Georgia was an overlooked state to a large degree on Bitcoin mining. And I think it's actually smart to be overlooked unless you understand energy. So if you go there, it's a regulated market and the industrial rates are hour by hour. So you need to be able to respond to the power prices on a real-time basis. Now it's different than Texas. There's no big rebates if we turn off, and there's no fancy program that's in there. Instead, it's about predicting power prices, using power at the right time. Now, we don't turn our facilities off often, but for example, avoiding 100 to 200 hours a year, which is just a fraction of the time, we can have up to 30% less power prices. And so coming from a background where we interacted with grids specifically for economic response, Georgia was the perfect home for us because it was really predictable. It's also a state with very abundant power. So there's not a shortage issue, which is part of the reason they don't have all these other programs. So it created us a home where we could really understand the utility, grow with the utility, develop relationships. We're the largest purchaser of power from one of our utilities. We're across 3 utilities, but one of those, we are the anchor customer. That makes us important. It means we have buying power and influence. You go to certain places in the globe, and you're just going to be a dot on the map, right? And additionally, community. The community in Georgia is not only business friendly, but we have focused on rural development. And that has become a big part of our strategic advantage down there. We have what we call the front door approach. We don't back channel anything through any city councils, anything like that. We show up, we meet the city, we shake their hands, we employ their people. We don't bring trades from anywhere else. We employ local contractors when we build, and we do it the right way. And we're conscious of our impact on the communities. That community relation we have has been an immense advantage for us. And it's also had an immense impact on the community, where we're able to increase city budgets to large degrees, build parks and streets, and everywhere that our tax dollars go. That is all a really important part of why Georgia we chose to make home. And again, from a headline point of view, you're not reading about the complaints coming out of Georgia because we're the miner in Georgia and we're behaving responsibly.
Can you talk about your recent expansion into Mississippi and the facilities you acquired there? Really, if you could just talk about what attracted you to the state, how you're thinking about future expansion as it relates to geography.
Absolutely. So in that area, it was kind of an obvious move because the main utility there is parent company, Southern Company, same parent company for Georgia Power. They run on a very similar system. It actually has a few programs that have some advantages to it. And also, again, there's still a few utilities to operate in. But it was another state that was largely overlooked. So instead of being a crowded state where, it feels like there's a Bitcoin miner, wherever you throw a stone, like Texas, I think is starting to feel for some people, right? We wanted to go to a place where we could be the face of Bitcoin mining, where we could be part of the community, where we could have relationships, where we would be appreciated. Because what I will say is, a Bitcoin mine doesn't belong everywhere. Nobody wants a Bitcoin mine to, pop up in their backyard in the middle of an already busy city, right? Bitcoin mines are built, and they're just like they should largely exist in rural communities. Where better to go find rural communities than the American South? And again, we went into an area that we knew was going to welcome us with open arms. In an area where we understood, how the utility is structured. Now, our entry point was acquiring 3 facilities that were owned by another party that had a fixed rate power agreement already in place. Fixed rate power agreement, which was good, but not great, but it established a foothold as part of our portfolio as a really important piece of the portfolio now, right? We are at floating open markets in Georgia, and we have incredibly low prices, 9.5 days out of every 10, right? Where, just a few hours a year drops us into really advantageous rates. Well, now we have a fixed price over here that's kind of in middle of the road vanilla, and it can be a good anchor point. We will likely, in Mississippi, as we expand, which we will certainly expand, but we will likely look to floating rate programs there also, to where instead of doing a fixed rate, we will look to basically take the market, do what we do best, which is, participate in those power programs to run when it makes the most sense to run and not run when it makes sense not to run, and outperform what effectively is an energy hedge. That's really all a fixed rate agreement is the power party has taken a hedge or a fixed rate with the generator, and they're providing it regardless of their cost, right? So there's basically hedges, there's fixed rates, and then there's the floating rates. We perform really, really well on floating rates, and that's likely what we're going to pursue. We're, just over 40 megawatts in Mississippi, and we think that there's several hundred megawatts of expansion that can be done in the right place at the right time in Mississippi. So we see this as, this was for us to get a foothold in a state that we think is going to has really strong growth prospects in the future.
That's great. That's great. And staying on the topic of expansion, Zach, you mentioned on your last earnings call that you expect to exceed 17 exahash by April and to achieve 20 exahash by June, or call it the first half of this year, versus 16 online today. Is CleanSpark still on track to achieve these targets?
Absolutely. We just had an announcement, where we let everybody know that really the second week of April, we're going to have another facility come online. That power should be the difference between where we're at today and 17. So we said April 12th, I believe, in the social media post. We're tracking to be on that day or better, which is what's exciting. So that should really be our threshold day for 17. We expect to have another 50 megawatts still come online in Sandersville sometime next quarter. And we have a few other things happening, including we're building another 15 megawatts in Dalton. This has all been previously disclosed. All those pieces together get us over 20. So those timelines remain well intact for 17 next month, 20 by the end of June. And we're looking to continue to push beyond it. We're pretty excited about the prospects ahead of us.
And as a segue to that, looking beyond the 20 exahash, CleanSpark has locked in one of the largest purchase orders with Bitman that we've seen to date. And for those on the call, Bitman is one of the largest manufacturer of the ASICs, or the mining equipment that CleanSpark and other miners are deploying at their facilities. And the contract is such that you can acquire up to 32 exahash of S21s, which is their latest model miner, at just $16 a terahash, among the lowest costs or pricing we've seen so far for those pieces of equipment. And based on your comments from the call in February, it sounds like you're confident you'll exercise the full order by the end of this year, which, if you were to do that, would effectively lift total capacity to over 50 exahash a second. So for the investors on the call, how should they think about growth beyond, again, that 20 exahash as we look beyond the first half of 2024?
Our expectation and what we've communicated is that we will absolutely be growing. We expect to exercise the option on that, which was another 100,000 machines that would push us up towards 50 exahash. The only thing we haven't given guidance on is time, but we're incredibly confident that we will reach those points. What we're excited about, maybe to talk a little bit of strategy on this, and again, I'm speaking kind of broad strokes, again, no timing on this. M&A, we're very excited about the prospects. We say this every time we're on a call, but I'm going to continue to say it, because halving provides a very unique opportunity. Weaker players who have inefficient fleets and don't have capital to do a refresh of machines, they still have a great facility. It's an excellent opportunity to buy a data center and bring in the fleet that we just purchased and plug it in. We're already seeing those players there's lots of offerings going on right now. There's lots of processes being run, and there's lots of private discussions happening. The market's abuzz with M&A activity. So it's just a matter of, we want to take the very best opportunities, add them to our portfolio, and that's going to be what I would call our near and medium term growth is going to be M&A based, and we're confident that we will execute on that on a timeline that's beneficial for everybody. Beyond that, we're very excited to continue what we've always done, which is greenfield project building. What I mentioned in Mississippi, we don't have anything, currently penciled out and solidified, but we're excited about the growth prospects in Mississippi. We're going to, end up acquiring someone that will also have growth prospects, I'm sure, right? That just normally comes with a Bitcoin mine. Most Bitcoin mines, when they set up their, let's say it's 20 megawatts. There's usually an expansion opportunity. Those are the opportunities we're looking for. We don't just want to buy a facility. We want to buy facilities. We want to buy pipelines. These are the things that we're focused on, and that's how we get to 50 exahash. So no, we don't have all the infrastructure to get to 50 exahash today. But if you look at our historical track record, we've acquired facilities, we fill them with machines, and what you have is this interesting thing that happens in the Bitcoin space. You're either long machines, where you have machines that are coming at some point in the next several months, you go find a home for it, or you're long plugs and you're short machines. Right now, we're long machines, and we think that was the right choice for this time in the market. We have 20,000 S21s landing in April, May, and June. And then, as I said, when we exercise the option for the next 100,000, those will come then shortly after in the second half of this year and in early 25. We want to be long machines because the opportunities for data centers seem to be so hot right now that we believe we'll have no problem filling that up. So we're really excited about the next several quarters. Halving's going to be exciting for us. We're glad we're positioned for it to be exciting instead of the other way around.
To just kind of add to that, Mike, last cycle, the machines were the real variable, right? There are a lot of variables in space: power costs, global hash rate, the price of Bitcoin, but really what it was the price of the rigs. So at the beginning of the cycle, when Zach mentioned we started to sell our HODL, the 900-pound gorillas in the room, Marathon, Riot, they each committed to buy $1 billion worth of the XP machines. And they were paying $80 to $100 a terahash initially. And so that created supply shock for us. So as the smaller guy, the last kid on the bus, like Zach likes to say, we were forced to look at how do we bridge that gap. And so we have a very unique perspective in that we bought machines when it made sense. We bought all different manufacturers of machines, and we ran them and we tested them out of need. So the purchase that we made of the Bitmain machines isn't because it was the best price or there was a promotion on pizza day or whatever the case may be. It's because we have familiarity with literally every manufacturer of ASICs on the planet, and we made this decision by choice. It's like Southwest Airlines, right? We'll fly anything as long as it's a 737. We feel that level of commitment right now with Bitmain because we have the familiarity with operations, with warranty, with installation, but then with technology also. So that's another really exciting point. So back then, when there were a couple of $1 billion worth of machines committed, what I think a lot of people looked past is that's going to drive difficulty up, which squeezes margins. And then we ran, put on our energy guy hat, and we ran modeling about where does the price of energy go? And you look at some of those future models, and this predated the war in Ukraine. So not even including that, we're seeing difficulty going up by virtue of the massive rig purchases. We're seeing significant volatility and a very peaky nature in the cycle of the price of the underlying commodity. We're seeing a bunch of variables that we can't control. So that was when we made the decision that we're gonna sell this HODL. We're gonna buy the immersion equipment and the transformers and the switch gear and the power supply units, and we're gonna prepare ourselves. And so something that's different that I think maybe is worth talking about. Companies were paying earlier in the cycle 70, 80, $90 per terahash for machines, and they are now depreciating those over 3 to 5 years. We went into the market and bought those same machines in the 20s and teens, and we've accelerated depreciation on anything that wasn't as efficient. So what that really speaks to, Mike, is we've tried to maintain balance sheet strength so we can demonstrate to our investors that have entrusted us with their capital that we're forward thinking and we're being aggressive on all fronts, not just the machines, not hosting agreements, not just infrastructure, not just technology, but we try and take a balanced approach. And what we've done is surround ourselves with people significantly smarter than we are in their individual areas of expertise to kind of shore up any weaknesses that we have on our team. So all of those components and then the people are really what the engine is.
So here at the bank, we cover about 95% or so of the total publicly traded mining landscape of, call it 20 miners. And what we'd say is CleanSpark is one of the, if not the best positioned miners heading into this halving event, which is now 25 days away when we get to the 840,000th block on the Bitcoin blockchain. It's a very hyped up event right now. Once in every 4 years, this occurs on the Bitcoin network. And Zach and Matt, you touched on some of the things you've done to prepare for it. If you could just share your expectations around the potential for Bitcoin price action, where we should go directionally, after the halving event. I know it's a hot topic right now in the media. And then also your expectations for the network hash rate. We know there's some weaker miners out there that may have to unplug. So any sort of views you have on that. And then you also talked about some acquisition opportunities that could potentially get more interesting after the event in April, which again is 25 days away. Just curious if you could provide some more color on the pipeline there.
Yeah, so I'm going to try and hit all those points, and I'm just looking at time too, so I'm going to try and keep some of these answers a little abbreviated. Let's talk Bitcoin price. Where do I think it's going to go? I'm going to be real short and sweet with it. I think it's going to go up because I think that the supply shock that's already being felt on the ETFs will just get bigger. The ETFs, it's kind of interesting if you watch how it trades. The volume leading up on a Sunday is the certain overseas markets open up and move into the weekend because of the T+2 trading and T+1 depending on which ETF it is. There's just a massive amount of capital still flowing in, and again they're all looking to gobble up Bitcoin, which is disappearing off exchanges at record rates and things like that because it's going into these ETFs and getting parked on a shelf effectively. So Bitcoin is simple, and that's what's great about it. It's really it's a exercise of economics, supply and demand, right? Do I think the supply shock will be felt immediately the day halving happens? No, but it will be over an extended period of time. It's the same way that the ETFs launched, and everybody said, "Wait a minute, how come Bitcoin didn't go up?" It actually went the opposite direction. It took a few weeks for all these ETFs to gear up and get the cash moving and everything to go with that. It's going to be the same thing. Supply shock will be felt. It'll go up. Acquisition opportunities. Let's just say there's a lot. There are right now hundreds of megawatts of conversations happening. And that's just in the US discussions that we're aware of. And I will tell you, we're not interested in half of them because it was, a weak miner in the wrong power spot, and there's places that won't be good for mining anymore. Even with the most efficient rigs and a $70,000 Bitcoin price, you're gonna have to unplug, which leads into the the difficulty side. And I'm just gonna give an example. Canada, right now, there's certain areas in Canada, not all areas, just certain pockets where miners exist today. It will not make sense to mine there, no matter what rig you have, in 25 days, because difficulty would have to drop off the face of the planet in order to compensate for the high power prices that are now being pushed across in jurisdictions due to how the markets are structured. So on the difficulty side, if you'd asked me a month ago, maybe 45 days ago, I would have said a 30% drop was a sure thing post-halving. Bitcoin has moved from, high 40s all the way to 70 now. I think that drop in difficulty is probably, 7 to 15% now. And it probably recovers 100 days afterwards as new hash rate comes online. So if you extend that over a 100-day period, I'd say the drop in difficulty is going to be temporary and largely flat before it starts to build again. Now, if Bitcoin, takes a retrace or anything like that, my answer would change. So that's the really interesting thing about making sure you view this day by day, is the dynamics can be measured real time when it comes to difficulty, Bitcoin price, hash rate, all of those things are all available in public. And the market moves real time, so it's great, and we're going to keep watching up to the day up. What I can say is, even if difficulty was to go up on halving and never dropped, we're well positioned to handle it, because again, we are building for the next 4-year cycle, so we're not really worried about it on our side. Instead, we're just anticipating the opportunity. So whatever drop in hash rate it is, that goes to our bottom line.
Mike, just one quick point to that as we lead into halving, for the members of your audience that aren't super familiar with the way that Bitcoin mining works, they're all different types of machines, just like they're all different types of cars on the road. And at the end of the last cycle, the average machine consumed about 38 watts to process 1 terahash of data. We don't have transparency into what the global network looks like, but it's theorized that it's on the plus side of 30 watts or 30 joules per terahash. So our fleet right now is in the low to mid 20s per terahash, and that will drop with these new machines coming in. So what that means is, for the same amount of power, we can mine 50% more Bitcoin than the average of the global fleet, assuming it's in that 30 joule per terahash range. So when you look at, and what Zach said when we talk about M&A, there are many companies, many miners that have built really top quality infrastructure. They've got, copper-based wire rather than aluminum. They've got good transformers and switchgear, but their fleet of machines may not have the efficiency profile that the unit economics would work post-halving unless Bitcoin goes to 100. So we're positioned well with the optionality of these machines, that when we find the right one, and as Zach mentioned, there are probably 24 on our board right now in some stage of due diligence, that when we execute on M&A on facility side, we'll find a place to go with the machines that are there. There's an active secondary market. A lot of private equity guys are trying to get into space, but we'll repopulate that thing immediately with the most efficient, fastest, best machines on the planet, maintaining our lead and even building that as far as efficiency goes. So really comes down to being able to squeeze more juice out of the lemon.
A very important metric as we head into the halving, for sure, as we look at the fleet efficiency there, Matt. And looking at operational efficiency now, so CleanSpark is consistently at the top of the charts as it relates to maintaining one of the highest realized hash rates in the industry, meaning that your Bitcoin production closely tracks your operational and deployed hash rate. What's CleanSpark's secret sauce? How are you guys able to really sustain such high levels of uptime? And Matt, I know you touched on this a bit before, but love to get more color here.
Yeah, so I think it starts with the fact that we're aligned with our team. Everybody's a shareholder, everybody's pulling the same direction, and there just some fun little anecdotal things that our sites have site managers, and then there are teams of team leads within the site, and there are incentives, whether it's a t-shirt and a hat or whatever the case may be. There are incentives for this uptime performance, which it stimulates this competitiveness, but it creates this opportunity for collaboration. So Taylor leads a call. Taylor and Brad lead a call every Tuesday that every Monday, and it's our ops call. And the site leads get on the call and they talk about what's working for them, new mechanisms for changing filters, new efficiencies, and whatever the case may be. So while Zach is busy acquiring the best machines at the best price, and Taylor and Bradley and Zach collaborate on time of use and using our technology to accelerate when prices of energy are low and Bitcoin is high, or to decelerate and underclock those if temperatures go a little higher. But we have this technology stack at our disposal. But then at the very kind of core level of our company, it's the frontline guys, the miners, the ones that operate the machines. And we have developed kind of a culture. You mentioned it in the beginning of your remarks, and you've been to many of our facilities to see that. But we've developed a culture where the people that work there, yes, they're shareholders, but they're owners, and they care about the facility. And you walk through, and the wrapper off a water bottle is laying on the ground, and I'm following a mining technician who bends over and picks up the wrapper and puts it in his pocket as we're walking through the site. How do you create that culture? Well, the thought process for that guy is, if that gets sucked into the fan and it's on my team, my efficiency may go from 99.8 to 99.7, and that may cost me the win for the month. So we've created this culture that they have pride of ownership in what they do, and that's our team members top to bottom. But they're also owners, so everybody pulls the same direction for the benefit of the greater good. And when you have the executive team executing at that high level, providing the best equipment, the best repair facility, the best power prices, and then you've got guys like Scott Garrison that are out building facilities that we can build faster, that are more efficient than most anything available on the market. So it's all of these relationships, and then you plug into a little community like what we've done. And gosh, there was a story on the Atlanta TV station with the economic development director in Sandersville saying that the margin. So we buy power from the city at cost, and then we let them make a margin, or they charge us a small margin on every kilowatt hour. So that money is earmarked to go into, like Zach mentioned, schools and roads and parks and libraries. But then in the state of Georgia, you pay sales tax on utilities, and part of the Territorial Act is the sales tax stays in the jurisdiction that it was generated. So those sales tax they're now using to cover all other kinds of their budget. But the city manager, Judy McGarrell, said on an interview on TV that surplus sales tax is now pushing down property tax and pushing down utility rates for the ratepayers in the community. So now we're faced with city managers and mayors and city council people reaching out to us saying, hey, we've got great teams, we've got great power, we've got a big desire for you guys to be here. What do we have to do to invite you to come to our community? And that, my friend, is the biggest accomplishment that the CleanSpark team has made, and that is the front door policy Zach said. People love to have us there, they love to work with us, and they love to work for us, rather than grab your torch and pitchfork and run the Bitcoin miner out of town.
I'm going to add one more thing, Mike. The thing that we championship the most, and I call it our top core value, is grit. And it's not just rolling up your sleeves and doing the hard work, but it's about caring, and to the point of kind of giving a damn, right? And a key thing with this, and everybody I think has heard of the book Angela Duckworth wrote called Grit. Great study on grit and how to create gritty teams, studies Olympians and so forth. But the number one thing to build gritty teams is to already have a gritty team to start with. So if you start with a gritty team of 2 and you add more to it, people will naturally behave like their peers. We make sure that every single person in this company is gritty and cares. So they're willing to work hard, and they're willing to push that extra mile in whatever they do, because that's the CleanSpark way. So you pair that in with rural communities, and that's kind of where Matt was driving. It's pretty easy to find that grit in those communities, and we really incorporate it directly into our culture, top to bottom.
That's great. That's great. Really strong culture there. And as I mentioned, I toured your facilities out in Georgia. Everyone is highly engaged and really just happy to be there and contribute to the broader organization. So as the investors in the call can see, very, very strong culture here at CleanSpark. Switching gears over to power costs. So power costs are very critical in maintaining profitability for a Bitcoin mining operation over time. You paid just under 4.5 cents to power your facilities in Georgia this most recent quarter, and also locked in a 5-year PPA in Mississippi for 5 cents. So as we look out through the rest of 2024 and beyond, how should investors think about CleanSpark's blended average power costs? And at some point in the future, Matt and Zach, would you see yourself potentially hedging power in Georgia? I know you're going floating now and trying to time the market, but any color there would be helpful.
Yeah, so I'm gonna answer in a couple different ways. So the power costs in Georgia are, better quarter by quarter, actually. So right now, if anybody pays attention on this call to kind of where natural gas surplus is and things like that, all power generally indexes to natural gas. And then it comes down to, on a regional basis, whether you have abundant power and what the sources are. In Georgia, a lot of the power comes from nuclear power, which is what drew us to the state in the first place. A base load that always wants to get used. And when it's not getting used, that drives power prices very low. So we've seen, for example, on an hour by hour basis, as I mentioned, we buy power in, power is, consistently in the month of March was in the 1 cent plus range, right? And then there were other hours that were, 3 and 4 cents. I expect, and if you look at last year, to give an example, that really the shoulder seasons have proven to be very strong for us. We're in one right now. We expect these power prices to continue to be very strong and very low. So I frankly expect, this quarter or next quarter probably be our, better power prices than we've had the last few quarters. And so just from a trajectory point of view, really happy in general. To your next question about hedging power prices to lock it in, we have consistently, so every single month we have an opportunity to buy a hedge. We can buy as much power of our power portfolio to hedge. But then what we do is if we pass on that, which we historically have done, we basically set a target that we are going to see how we can produce to basically outperform the hedges made available to us. And 12 out of the last 12 months, we have outperformed the power hedges that were offered up. Meaning, if the power hedge was offered at 3.9 cents, right, we want to come in that price or better. So, you point to the 4.4 average. The power hedges offered during that quarter were above that price on a month-to-month basis. So we beat the power hedge. Because you got to remember, power hedges are being sold by a variety of financial parties, generators, utilities, so forth. There's a bunch of people in the background that are trying to lock in certainty while still make a buck, right? And the reason they're willing to lock that in is they're trying to play the middle of the road. They're like, hey, if things go really good for a generator, which means, power prices spike, they're going to get more revenue. But if power prices drop, they're going to get less revenue, and they may or may not cover their operational costs, right? So you need to know whenever a hedge gets put in place, that's generally representing a middle of the road opportunity. And so we try and outperform it. Do I think we will hedge our power at some point this year? I do. But I do think when we do, it will be a portion of the power. Because as much as we've been outperforming power on a historical basis, for the last several years, you always want to be protected against kind of outsized events. So because our portfolio has gotten so big, it's just sound management to start to hedge portions of it. But I don't think we will ever hedge all of it unless that middle of the road opportunity was just so good we couldn't turn it down. And with the energy markets being as dynamic as they are, that's not something we're going to anticipate for. And secondly, a power hedge always requires a financial commitment, which usually means you take cash or other assets and you put it in as custody that can pay that hedge. That keeps the capital on our side of the wall, and we're using it to build instead of just locking a power rate, because we're looking at that on a cost of capital point of view. If we can go out and we can build a site and generate, revenue that results in millions of dollars more revenue in a single month, we'd rather do that than save an extra $100 grand on the power bill. So I know it's a long-winded answer on it, but the point is, we're very thoughtful. We do things for a reason, and there's a reason we haven't done it yet.
Now, looking at mining infrastructure, most of your data centers right now are air cooled, with the exception of about 20 megawatts or so deployed at your Norcross facility in Georgia that uses immersion. What observations have you made as relates to cost differences and performance differences of air cooled versus immersion? And would you consider using immersion for future data center locations? We see different miners taking different approaches to this, so we'd love to hear your views.
Yeah, we're going to take the right approach for the right places. And there's absolutely places where immersion makes more sense. You know, Matt mentioned Taylor Monick, our senior vice president of mining. He really, right, you know, keeps everything online and running on the mining side. He has several patents in both single and dual phase immersion. So he used to, you know, be a founder of a company that built those. So we are probably more versed in a background in education, as Matt mentioned, finding experts that are experts at the best things in that. And the fact that we're building air in certain places, what we're looking for is ROI. So we know all the benefits that immersion can bring, but if you, for example, have to spend, you know, more money on something, we're looking at the time it takes to hash that back. So anything that's $100 more, right, in total cost, you know, current mining, it may take 7 to 10 days to earn that $100 back from a single miner, let's say, right? So we measure everything that way. Two phase, for example, it's something that's being talked about a lot. One of the reasons it doesn't make any sense is because the fluid is so expensive that sometimes the payback on that is never. Yeah, before you have to, you know, change your fluid, adjust it, do things, you know, whatever it may be. Also, there's so much R&D that goes into it. You're going to notice that we are not releasing a bunch of headlines that talk about R&D projects and side projects. We do one thing, and we do one thing really, really well. That's mining. We have owned manufacturers. We own a switchgear manufacturer. We don't anymore, and we sold the business with the energy company years ago because, one, there's more margin in Bitcoin mining, but it takes a lot of expertise to run that, and margins are thin. So why would we own a switchgear company? Why would we manufacture our own tanks when there's experts that make immersion tanks, right? So point being, as I kind of work backwards through this, we know air, we build air, we also can build immersion. When we do build immersion, it's a single phase immersion because it's the most cost effective. And so I'm driving to a point here, which is cost. When we built our immersion site, we wanted it to be big enough to experience a real deployment, 20 megawatts. It's not small, but it also what we weren't going to bet the farm on 150 megawatts of immersion. We wanted to learn and experience in a real-time way. And we've now run that site for well over a year, and we've learned a lot from it, but only now have costs adjusted to where we can now go out with our connections and our vendors. We can build an immersion facility for about the same cost as an air-cooled facility, which means now we get to measure not just on the build cost ROI, but now what does it do for the miners? We can get great performance out of air-cooled miners. We can get slightly better performance out of the immersion miners, 15 to 30% better. Anything beyond that, you start to lose efficiency, which means we're not making as much money. And so that's what we pay attention to first as a strategic point. So now we're looking at this in a new way. Now, as we launch into 24, I do think that we will build more immersion. But I am not going to say that every site we're going to build is going to be immersion. I just think that we're going to build a lot more immersion. I think that there's still going to be great opportunities for air-cooled, great opportunities for immersion. For example, though, it's also a lot quieter. There are pockets in places that we've looked at we haven't built because nobody, again, wants a noisy Bitcoin miner, you know, too close to anything. Our immersion facility sits in the middle of a community, and there are, you know, houses across the parking lot from our facility. It's incredibly quiet. You don't know we're there and we're Bitcoin mining based on the reputation of it being noisy. That is a perfect example of why to use immersion mining over air-cooled. And then the other thing is, again, the miners last longer. So as we're bringing in this new fleet of machines that we think has an extremely long shelf life into the next halving, that's a great time to take those brand new miners that are going to, you want to put in a tank and leave them there for 3 or 4 years, you build an immersion facility. So all of those reasons together, yes, you're going to see us build more immersion in the coming year, but we are going to walk, not run into it, even because of our expertise on this, knowing you have to get it right or you can spend a whole lot of money and it'll never pay back.
That's great. Really insightful on the immersion side. And Matt, I recall last time I was down to your Norcross facility. There were several analysts. I was not one of them, doing samples of your immersion fluid out there. So although it looked like Mountain Dew and it's a nice tasty soda, I did not partake in that. So be interesting to see what you guys do next.
So just real quick on that point, Mike, that the fluid in single phase immersion that we use is it's effectively mineral oil. Okay, it's not an environmental contaminant. It's biodegradable. It has no legacy that you have to worry about. The current fluid available on dual phase, not only is it north of $300 a gallon, but under certain circumstances, pressure and temperature, it can convert to the same chemical element as mustard gas. So when we look at and evaluate these opportunities, first and foremost, you have to think about the safety of the people operating that and then the surrounding communities. So, to your point, I think you were there, Dan Weiskopf from the Block ETF, put his finger in the fluid and tasted it and posted it on Twitter. And you probably shouldn't do that, but you can. But that's just evidence or proof positive that there are a lot of benefits to single phase immersion, and that's why we've chosen to kind of balance that approach.
Yeah.
That's great. And Dan, if you're on the call, hope all is well on your end, and the mineral oils did well for you. So switching gears now, I want to talk about CleanSpark's treasury strategy. I mean, you guys have had one of the most dynamic Bitcoin treasury strategies of any of the public miners, and you've historically done a great job of timing the market. Zach, you talked a little bit about this earlier. And over the past few months, I've noticed that you've held on to most of the coins you've mined. So my question is, why the pivot, and what could investors expect to see as it relates to your HODL strategy in a post-halving environment?
You should expect it to continue to be dynamic. Although I do expect for the foreseeable future, we are going to be adding Bitcoin to the balance sheet. But we're adding Bitcoin to the balance sheet right now because we have a belief and an expectation that on a short to medium term basis, it's going to continue to go up. I think on a long-term basis, it's a straight line, right? If you measure it over 10 years, it's got nowhere to go but up. With that said, though, there's going to be opportunities to monetize the Bitcoin and to during downturns, bear markets, things like that, and then to essentially reinvest all those dollars into getting more Bitcoin. That was our adage actually during the time period that we were selling Bitcoin. It was use Bitcoin to get more Bitcoin, right? Right now, we believe we're doing the same thing, but it makes sense to hold the Bitcoin until the right time and the place and the value goes up, right? Because we're currently mining Bitcoin for sub $20,000 on a direct cost basis when you look at power costs and things like that as our direct input. And then we're turning around and it's all up to 70,000. So sure, Bitcoin was 45,000 in January, February, and here we are today. That means we kept all that value and we built it. When we see the tides shift, and again, Bitcoin is proven to be cyclical. Usually in every 4-hour cycle, it's kind of a split 2-year up, 2-year down, bear bull. When we see this tides turn, we would sell our Bitcoin, turn it back into cash, and restart the process. Now, with ETFs, I think those cycles are going to be a little different. And so they may happen sooner, they may happen later, all depending on all those factors. But again, I'm going to go back to what I said all the way at the beginning. We look at this as today is today. We're going to measure it real time. And so we will continue to make our decisions on Bitcoin on a real-time basis. But I will reiterate, currently right now, we see no reason why we would change direction. And we want to continue to add nearly all the Bitcoin to our balance sheet that we produce.
In looking at infrastructure-related costs to support incremental expansion from here, you guys have really laid the foundation by locking in the $16 a terahash for the S21s to get you to the 50. But really on the infrastructure side, how should investors think about that capital expense going forward?
I think the way to think about it is we want to deploy capital largely in the M&A in the near term. And the benefit to the M&A side is with the machines, again, since we're going to be long machines, we'll almost immediately plug in machines and produce cash flow from that. And so right now in that market, acquisition costs can be in the, $500,000, $600,000 range per megawatt. For a quality site. Whereas when we're building sites, which we do, and we will continue to do, that capital cost can be in the high $300,000 range for, again, a quality site, right? And so there's a big delta, but the difference in that delta is timing of the return of that capital. So when we build, we want to keep it under, or I'll call it in the $400,000 range, right? All in getting it built. And we're willing to, we save a bunch of money on that. We're willing to pay up a little bit when it comes to, I can plug a machine in tomorrow because it pays for itself, that delta, right? So the way to think about it is, I guess that, it's going to be in the 500 plus ish range for things we acquire, but they're going to turn on right away. And when we build, we're going to try and keep it around that $400,000 mark because we build facilities that are going to be here in 10 years. We don't just buy a pod that we're going to have to buy a new pod in 3 years. We don't treat our data centers as disposable. And I think that's the key takeaway in that too, is we're not going to, we look at maintenance cost over, 10, 12, 15 years instead of replacement cost under a much shorter time period that many of our peers look at.
Duncan and Scott and Tyler and Taylor spend a ton of time on airplanes looking at opportunities, and there have been a ton of sites for sale. You've seen in the news, some of those have been picked up. We're looking at sites that fit the CleanSpark way, and it's little things that you wouldn't think about, but like running the power cables from the transformer to the racks using aluminum can save you money, 50% less than using copper, but it doesn't dissipate heat as well, which causes system failures. So when you look at CleanSpark's uptime, we talked last earnings call 99%. You look at the rest of the industry, and what you can see there is the direct impact of vertical integration and quality infrastructure. You put that out to hosting, or you build maybe for budget rather than for the long term, and you're going to see an immediate direct impact on that efficiency. So when he talks about a quality built site, it comes down to what's inside the wire casing that leads a go, no go decision, even in some instances.
That's great. That's great. I think we're running up on time here, but guys, this has been tremendously helpful. Really, really interesting conversation. Matt and Zach, really appreciate your time. If you had any sort of last minute comments you want to throw out there to the investors on the call, by all means. If not, we can go ahead and wrap up the event here.
I'm going to say something that I think is just interesting from a viewpoint that I guess I would share. 4 years ago when we started this, we started preparing for halving. We actually said we want to be amongst the top 4 or 5. We actually set a goal. We set it publicly, be amongst the top 5. Internally, what we said is we weren't going to be the biggest to be the biggest. We weren't going to be any one thing to be it, but we were going to be the very best Bitcoin miner. And I think we're at a key inflection point where we are there, and we're going to continue to fight to stay there. So, I'm excited for halving. I think we're incredibly well prepared. And, I think that the good fight that's been fought by our teams and our people over the last 4 years has positioned us incredibly well for the next 4 years.
And thanks to you for making us your top pick. We endeavor to make you look smart.
You guys have been doing just that, and appreciate it. So it's definitely been great to see the ride here as you guys have really worked up to 16 exahash, which is truly remarkable, being in the top percentile now of all public miners. And appreciate everyone on the call today. Guys, great conversation. And Zach, perfect way to close out the call. So all the best and continued success with the deployment of future expansion here.
Hey, appreciate it. Thank you, Mike.
Thanks, Mike.
Take care.
All right, that was fun. There was a lot of stuff going on there in regard to that call. A couple things to note. Expansion plans, let's start there. April 12th, they'll have their 17 exahash up and running from the sounds of it. End of June, they'll be up to 20 exahash. End of the year, potentially, they didn't commit to a time frame for it, but the goal is 50 exahash. And I think even with Mara's expansion plans, these guys, CleanSpark executes. I can tell you all of last cycle, just like they talked about here a minute ago, they sold their Bitcoin at the top. It's one of the things I loved about them. I thought if you're in the commodity space, whether it's corn, cattle, whatever it is, you have to understand when you sell your commodity. Their commodity is Bitcoin. I know everybody has like, the maximalists are going to be like, you never sell Bitcoin. That's the Michael Saylor approach, right? That doesn't work for a Bitcoin mining company. You sell at the top of the cycle. I love that Zach Bradford, though, the CEO, mentioned that this cycle might be a little bit different because of the Bitcoin ETFs, but they're still going to try and time it and get it to where they're selling the bulk of their stack at the top and then accumulating again at the bottom, using the money that they sold at the top like they did last cycle to be aggressive with their expansion plans. This is such an important thing with Bitcoin. And here's what I love. Like, let's look at this real quick. Bitcoin holdings. So again, you can see how these guys sold out. They sold all their stack at the top. They had very little. I actually wish they would have started ramping sooner, but look at their holdings now. Look at how quickly they've started to ramp up in holdings, whether it's US dollar or the Bitcoin itself. I love that. I love that these guys realize that in the bear market is when you accumulate Bitcoin as much as you possibly can. Ryan, thank you for joining. Because you ride that shit up, right? You want a ton of Bitcoin at $15,000. And then when you're at 70, life feels pretty good. And when you're at 150, or if you hit my target, which is 280,000, you're going to be really happy that you stacked all that Bitcoin. And my target, people think my target's crazy. James from Invest Answers just posted one for 430,000. That's his target this cycle. So if you think I'm crazy, he's fucking nuts, right? But you want this. That all the miners, there's so many miners that don't stack Bitcoin. And it blows my fucking mind. Like Wolf, and I don't remember if Iron was one of. There's a bunch of them where it's like, oh, we're super efficient, but we don't understand that it's smart to have a bunch of Bitcoin when it's at 15,000, or get as much as we can at that time, expand at that time, and then that balance sheet, especially with the new FASB accounting rules that went into effect this year, at least preliminarily, people can start using them now until the end of this year, in which case it becomes mandatory. But with those FASB accounting rules, now they don't have to mark it down to the lowest level of the quarter for Bitcoin's price. It's whatever it is at the end of the quarter. So from an accounting perspective, life is good now for these guys. And so you want all this Bitcoin. You want to see it appreciate in value. Because if you look at these two slides, you'll see the Bitcoin held, but look at the appreciation, how much greater it was from Q3 to Q4. You want that. You want that to help your book. And you can see that in these charts. Look at the revenue increases. I can show you a bunch of other miners that are lopsided and just ugly looking as hell for all these charts. These guys, no. Total cost mined per Bitcoin going down. Operating expenses plummeting. Bitcoin production still going up. Still going up. Revenue still going up. Mining hash rate. Look at the consistency of their growth in their mining hash rate. And yes, they diluted recently. This is the only downside, right? But every miner is doing that, and they're doing theirs strategically. They started to ramp in 2022 with share dilution. They were even able to lower some here before aggressively diluting again, because they want to be the biggest miner by hash rate. They want to be the most efficient. They want to be the largest, and they want to grow their stack astronomically and then try and sell near the top. And I'm sure a lot of other miners will follow suit. When these guys sell, I think you're going to see a ton of miners sell, because these guys know how to manage a company. And I wanted to speak to a couple of things to compare them against another big miner that people like to talk about, Mara, a company that I think I might have like 8 grand still in Mara just because I've been too lazy to hit the sell button. But I have no love for them. I went back and forth, but here's what's really made me not like them right now. It's the lack of focus. And somebody, Rex Finance on YouTube, he's also on X. He's only a 22-year-old kid, but he's pretty brilliant. Very sage-like for somebody at his age, way more than I was at his age. But he was talking to the fact that Mara is going in 20 fucking directions. They're trying to get revenue from their slipstream. They're trying to work with a mining company to produce miners. They're trying to do just a bunch of things. These are just a couple of them, but they're trying to do a bunch of things. They've got some altcoin, stable coin shit, trying to, I don't know. They've got coins that they're trying to launch alongside of this, right? Anduril or something. I can't remember the name of it. But essentially, it was another way for miners to make revenue. I've got a friend who's in the Bitcoin mining space. His name's Bob Burnett. He was a previous chief technology officer at a company called Gateway Computers years ago. Brilliant man. Cow-spotted computer boxes for the people that are old enough to remember them. But he says that Mara is not beneficial to the network, and because of their slipstream and the other things that they're doing, they could circumvent and then not be as transparent as other miners, and this could cause issues with the network. I trust him. He's run a privately mined company with tens of thousands of miners for a long time, and when my friend tells me that it's not beneficial to the network, I get the fuck out. So again, I don't like Mara's lack of direction and focus. I don't like the fact that their fucking mining hash rate is all over the place. This company had like 20 or whatever, 29 exahash. Then they were down to 8 for months. They were plummeting. Still don't have any clear fucking direction on any of that. They never responded to me whatsoever, even though I have a pretty decent presence. They could give a shit about responding about what's going on with their exahash and why they can't get it up. Why can't you get it up, Mara? I don't know. But I can tell you when a company lacks direction, and here's the one thing, here's what Mara has done right, okay? I made a ton of money off of Mara last cycle. Mara and Riot made a ton of money off of them. I think Mara was up like 140x or something from low to high. Stupid amount of money. Here's what they did right. It wasn't Bitcoin mining. It was buying fucking Bitcoin at the low. So they just did a convertible notes, took out debt offer, and they bought Bitcoin. So they're not even a good miner. They're not as efficient as most miners, or a lot of them. But they just bought Bitcoin at the right time. I don't know if they sold at the right time. I think they had a hodl strategy. And then they were big on the hosting solution. Last cycle, they were all like, we don't own the equipment, or we don't host the facility. We don't want to deal with all the overhead from that. Instead, we just want to buy the equipment and have people do it for us. That's the fucking nightmare they're dealing with right now. That's why this hash rate keeps dropping, because they let other people take control, and they didn't control their vertical stack, right? They let other people control it, and now they're like, oh shit, that's a bad idea. We control 50% of our stuff now, and we should look to do it more. I mean, it's good that they're figuring that out, but again, these guys aren't as responsive. They're not as calculated. I love the aggressive behavior of CleanSpark, where they realized that these guys put in huge orders last time. They sold their Bitcoin. They waited for a good time to be able to buy miners and do M&A and acquisition, basically, right? Purchasing other companies that were falling apart. They waited for the right times. They did that. They went from a tiny-ass miner last cycle to what is, I believe, in the prominent premier space and the #1 miner this cycle. Maybe not by hash rate yet, but Cores is going to fucking die. And Mara, I don't know if they're much better. So, and Cores already died once. We've already been bankrupt. They're just going to do it again. Okay? They lost all their Bitcoin. They had the biggest stack of everybody that's just fucking gone. So, when I look at these other miners that 60% of them don't even hold enough Bitcoin, fucking worthless. Pass them up. And then they don't know to sell at the top. They don't know how to be aggressive with purchasing miners at the right time. These guys have 120,000 Bitcoin miners at super cheap prices that they're going to be acquiring this year. potentially to get to their 50 exahash if they exercise it. I mean, that's great. And oh, something else, power credits. I used to think power credits were good, right? Riot does a lot of that. It's shit. These guys have a way better strategy. Texas with the power credits. Here's the problem you have. Oh, okay, so we get paid money from Texas, a nice amount, whenever we have to turn off our miners. That's great in a bear market. You know when that sucks? In a bull market. When the amount of money that you would make far out exceeds what you would get in your power credits. And so Riot right now hasn't done a good job expanding, had a CEO replacement between the last bear to this bull, and no clear communication on kind of what their strategy really is versus what it was before. At least they communicated better before, but operationally they just haven't performed. Mara hasn't performed, and then there's a bunch, and then Coors went bankrupt, biggest miner out there, poof, and now they're just trying to exist, and they're not going to. Their equipment's too old. And what are they going to do? Dilute the shit out of their shares? Sure. But they didn't manage it well the first time. What's the likelihood that they actually know what they're fucking doing now? How many companies do you have to fail at in the same business before people give up on you? I don't know. Anyway. But I like what these guys are doing here. I like the fact that what they're doing is they're working with states like Georgia, where power isn't scarce from ice storms or needing more air conditioning like it is in Texas. Instead of doing that, instead of that being their primary focus, they're like, Georgia's got a shit ton of power. And they're giving us rates at these nuclear power plants that have to run all the time. It's not like you can turn the nuclear power off, right? These things like can melt down. You got to like keep them going. So they can get rates when power isn't needed that's incredibly cheap. And it sounds like as low as a penny per kilowatt hour. That's fucking insane. I used to run a mining company. I can't say I ran a mining company. I had a company that had over $100,000 worth of Bitcoin and other miners in a warehouse that I had created myself back in 2017 and 18. Eventually gave up on it because I realized investing was a way better way of doing it than trying to be a small ass miner with shitty power rates. So, but I know what these guys are dealing with, right? I've been through this on a small scale. I know how painful this can be. So my whole point is I think it's smart that they're working with states like Georgia where power is abundant and they don't have to worry about turning off their rigs, and where they can still work with them to be able to get extremely low rates. And if they need to, they can hedge part of that power. These guys are just so cool and calculated. And I love their expansion into Mississippi. That sounds great. They mentioned better prices for their energy costs in the quarters ahead. They think they're going to get better. So these guys not only are going to be lowering their cost basis even more, but their energy costs are going to decline. And again, their cash balance sheet is going up. Their debt is low. There's so much that these guys are doing right. And as their stack grows and prospers, the multiple in returns is going to look better and better for these guys because they're going to be PE profitable. And the financial guys, they don't give so many shits about like what are they compared to MicroStrategy. MicroStrategy's got a much bigger stack. They should be valued at more. No, they look at financials and they look at growth year over year, right? They're looking and saying, whoa, this company's growing a lot now. Therefore, we need to value them a lot higher than it is today. And so mining companies work this way. It's not just in the Bitcoin world, guys. It's in gold mining. It's in silver mining. It's all this stuff. They operate as a multiple of the underlying asset. So if the underlying asset's doing good and demand is high, they operate off of a multiple of that. And so CleanSpark and Cypher and maybe a few other miners, a lot of miners, if this cycle is really powerful, even the shittiest of shitty will be speculated on if people think that CleanSpark and Cypher and maybe Mara, some of the bigger ones, are already saturated. They'll buy the shit. They'll play hot potato. So I'm not saying a ton of miners can't go up. They can. They totally can. And they might. Of course, I don't know if they'll be around next cycle, but that can happen. But here's the thing. I operate off of best of breed because no matter what, I can tell you this, from this being my third cycle in this space, is that the best of breed will perform the most rapidly. people thought that was Mara, and now it's slowing down, right? But now CleanSpark's up in that lead, Cypher's up in that lead. You can see it in their price action. They're running right alongside MicroStrategy right now when other miners are not. So no matter what, you can make a ton of money off of them. And then if you wanted to nibble into these other shitty ones to see if you could get a multiple from their lag and their underperformance, you could do that later. But you don't do it now. That's my 2 cents. That's my advice. I don't know if I have a lot more to say right now. I do think it's helpful that these guys came from a world where they were trying to operate off of like renewable energy and trying to manage that. And that's a really tough world. So I think that's what's led them to their greatness today, because they had to learn how to pinch pennies and how to manage every little bit of power to juice out some kind of profit in their previous life before they started doing Bitcoin mining. And I think that is another key to their success right now. And anyway, I don't think I have a lot more to add on this. I will be going. I'm going to jump off of this, and then I'm going to go into the market recap here in a second. So if you guys want to talk more and just talk about the day that's happened, I'm going to be spinning that up here now. So love you guys. Thank you for everybody who joined. Hopefully you got some value out of this. And make sure you like and subscribe and ring the bell if you want to participate in this more. And it helps my channel a ton if you guys add some comments after the stream is done. The algo likes it. So if you guys could contribute there too, I really appreciate it. And everybody who's joined, like, you guys are so awesome. I can't believe, I think I'm nearing 800 members right now that have joined my channel. A huge thank you to all of you. I can't believe it. It's like up 110% from last month. It's mind-blowing and incredibly supportive, and I love you guys. So I'll see you in the next one.